Hey, good afternoon, everyone.
Good afternoon, Professor.
Hey, good afternoon, Tia. Good
Hi,
afternoon,
Professor.
Claudia. Good afternoon, Alicia. Hey, how's everybody? Good afternoon, Kadir. Um, I see, let's see, currently 11 people in the Collaborate session, and let's check how many are in the forum. Make sure that you sign into the forum. The first thing, right? I see only 10 because 11 means including me myself, right? So if you haven't signed into today's forum, please do that ASAP, right? Um, okay, so in our last class, okay, we were uh, just we were just about to start on the open market operation, right? And just to recap, why are we talking about open market operation? Because that's the Federal Reserve's um, main tool for monetary policy. And why are we talking about monetary policy? Because monetary policy is the reason behind the Fed funds rate going up or going down. Okay, and to talk about, remember, Fed funds rate. We were talking about, the Fed funds rate. The Fed funds rate is the baseline of all the interest rates, and the interest rate is important because um, as interest rate goes up or down, the economy goes down or goes up, right? And so we need to understand how interest rate is changed. And to explain that, we had to come to the uh, bond market operation. And to understand bond market operation, we talked about the basic properties or the characteristics of the bond. So again, open market means open bond market. That in other words, bond market is open to anybody. In other words, any investor, any market participant, in individual or institutional, domestic or foreign. Okay, so the bond market participants can be, and the biggest chunk is, of course, the institutional investors. I mean, no matter how wealthy an individual investor is, still the the total amount of capital that individual investors can mobilize would be a small fraction compared to the size of the capital that the institutional investors can mobilize, right? And even if you're a wealthy investor, even if you're a wealthy individual, if you're a wealthy individual, you don't do um, you don't do your money management yourself. Your Most of your wealth is managed by professional portfolio managers, right? You wouldn't. Most of your wealth is already held in uh, uh, but held in the form of um, deposits in the asset management firm, right? Managed by a portfolio management manager. Uh, so if I'm a billionaire, right? And if I have $10 billion, most of my money is under the management of the institutional investors, and therefore the size of the capital being managed by institutional investors is way greater than the size of the capital managed by individuals, right? So anyway, domestic or foreign, institutional or individual. So um, to illustrate the Federal Reserve's open market operation, let's assume 30-year 30-year U.S. Zero coupon U.S. Treasury. Okay, 30-year, right? Zero coupon U.S. Treasury with terminal time 30 years. That means maturity is 30 years. So that means if this bond is born today, we have 30 years left maturity, and this is a zero coupon bond. And you should remember what zero coupon bond is, right? If you've been following this class um, closely, and I always release the lecture videos in advance, at least like 1 week in advance. And if you've been studying, you would know, you should know. And then even if not, I always post, right, in the uh, in the topics folder. I always post the recording of the live session all the time. So if you've been following all of these, then that was what we did last week, right? Uh, you should be already familiar with that. You shouldn't say what, right? Um, so zero coupon bond, I already explained, is non-interest bearing bond, right? Um, it doesn't pay any interest. So the only way zero coupon, so think about it. If it doesn't pay any interest, the only way it can sell, right? If it doesn't pay any interest, there's no incentive for any investor to buy such a bond. But that's why uh, they sell at discount. They sell at deep discount, right? So that, uh, so here's the example. I told you in the last class that a typical example, actually, 30-year zero coupon U.S. Treasury bonds are generally sold in any retail banks, any commercial banks, and they generally go by the name U.S. Savings Bond. U.S. Savings Bond. So, and they sometimes they go by the issue series, right? In other words, the bonds, when they are issued, they have serial numbers and followed by the serial code, something like, about 20 years ago, uh, they had like double E bonds, series double E bonds. But since then, I didn't, track, it's not really, it's not really crucial thing to know them by their series number. But because that was 20 years ago, maybe now if there was a 30-year uh, zero coupon U.S. Treasury, then the series may be double Z or whatsoever, right? So they are, these U.S. savings bond generally sell for $500, right? $500. So, in other words, 30 years later, then they pay you $1,000. So that means the holding period return, right? 30-year for 30-year holding period, the holding period return is 100%. Now, that's that's the only way it can sell, because otherwise it's not paying any interest. Nobody would be if it isn't paying any interest, and if not selling at discount, then there's no reason for anybody to buy such a bond. So basically, it's designed to be that way. So that bond will have to sell below its par value. So it's a discount bond, basically, and this means price of the treasury, right? The selling price of the treasury must be less than its face value. Isn't that right? That's what is meant by selling at discount. So in our example, it's 500 and face value is always 1,000. So this difference is called bond discount. Literally, that's how much it is discounted for, right? That's how much is discounted by. So bond discount. But we know this by another name. We already know this by another name. Um, can anybody tell me what we call this? We've been calling this. Hmm? Can anybody tell? No one?
Capital gains,
Yeah. Who said that?
Mukhtar.
Mukhtar. Okay, Mukhtar, you got 0.5. Yeah, we've been calling it capital gains. Isn't that right? Uh, you got 0.5. That's what we've been calling capital gains. Yes. So think about it. Then, um, if we find a return on the Treasury, or rather return on investment in Treasury, it should be, if I say return on investment in return on investment, then I should say, it should be in Treasury, return on investment in Treasury. But let's say, so return on the Treasury, then it will be, think about it, capital gains divided by initial investment, right? Capital gains divided by initial investment. Now, remember, this is just like the scenario one. This is just like the scenario one of the house value example, right? Uh, why? Because in scenario one, uh, you buy the house and use it just as your home. So there's no additional income, additional cash flow. It's just, capital gains or capital loss, right? And by definition, all zero coupon bonds are like scenario one, all zero coupon bonds. And coupon bonds are like scenario two, right? Because if you, in scenario two, you buy the house and rent it out. So there is definitely capital gain or capital loss. Ah, I'm afraid if you hear this noise, maybe, I also explained this last time. Um, Someone's doing some construction work above my head. So there's a lot of, drilling and jackhammer and all this. They're tearing down something and, probably grinding the wall or floor or the floor. So um, if you hear this background noise, please, uh, uh, I would appreciate your understanding. And for me, it is really unbearable because it's just pounding my head. Ah, I just lose train of my thoughts whenever this noise is, pounding my head. I lose the train of my thought. Ah. So anyway, the point is, um, remember, the formula to find holding period return includes, basically, capital gains. That's capital gains, right? PT plus n minus PT. That's capital gains, and this is, additional income, right? In scenario two, this term, right? Summation or sum of all the cash flows. That term is positive, but in scenario one, this term just drops out because it is zero, right? So if this is zero, it's exactly the case of our zero coupon bond, right? So the return on investment in the Treasury can be calculated this way. Oh, please. And then this return is called risk-free return. This return is called risk. Why? Now think about it. Um, and from early on, I said there are only three risk-free assets. There are only three risk-free uh, returns. The first one is return on your savings. In other words, interest rate on your savings. Because bank interest rate is really immaterial. It's not even 0.1%. And I've been telling you, and it's because the Fed funds rate is like 0.25. So if you deposit $1 million in the bank, this 1 million can be loaned out to someone with excellent credit score, and someone with excellent credit score will get something like 3.5%. Someone with the borrower with excellent credit score will be charged something like 3.25 or 3.5%. And I told you that's called prime rate, and prime rate is conventionally 3 to 3.5% above Fed funds rate. Okay, you remember that? Prime rate. Okay, but think about it. This 1 million, let's say, was not borrowed by anybody. Nobody came to borrow 1 million. Then the bank loses the opportunity to earn 3.5% on this 1 million. But then at least banks can lend to each other overnight. Banks can borrow from and lend to each other overnight through federal funds market. So that's why Fed funds rate is important, because that's the baseline of all interest rates. So at least the bank can lend that 1 million to another bank at 0.25% interest rate a year. Right? If they borrow for 1 year, they will pay 0.25%. But usually, between the banks, they don't borrow for such a long time. It's usually just to cover up, just to cover for overnight, right? Because the next day, there will be money coming in. It's a bank, right? The check will be cleared, and the cleared check will, the cash will be deposited from the cleared check, right? And et cetera, et cetera. So let me use this. I think it's easier. So if 1 million is loaned out to another bank, right? So this is bank A, your bank, and it came from you. This 1 million came from you, right? And they loan it to another bank, bank A, bank B. And just to make it simple, let's say, so they loan it at 0.25%. So bank B will lend it to someone called Mr. X. And Mr. X has excellent credit rating. So his rate will be 3.5%. So then he pays back, right? He pays back, 1.035 million. He pays back 1.035 million. That's like 1,035,000. And then they get But when they pay back to Bank A, they will only pay back 1.0025 million, right? 1.0025 million is 1,002,500, right? 1,002,500. And the difference, right? The difference between the two, right? This difference is what Bank B makes, right? And then when they pay back, right? When this Bank A pays back to you, right? They will only pay back. The rate is, like 0.001, like 0.1%. It's not even 0.1%, right? Then they pay back, 1.001 million, right? 1.001 million is like 1,001,000, right? And then here the difference between the two, right? The difference is what this bank makes, right? It belongs to Bank A. Okay, so that's why your rate when you lend to the bank is so low, because the Fed funds rate is so low. But you cannot. The bank will still make something, right? By lending your money. So if you understand the mechanism, right, then you understand why interest rate on your savings is risk-free. It's very safe, because not only because it is only very low, but also all your deposits in the banks are insured, secured by FDIC. FDIC is Federal Deposit Insurance Corporation. So that means FDIC is the insurance company for commercial banks. So your deposit is insured up to 250,000. 250,000. Second, the second risk-free asset is CDs. I already explained what CD is, certificate of deposit. It's a kind of savings account, but it's a contract. It's not an open-ended account. It's a closed-ended account contract. So you cannot, if you like withdraw early, that's a breach of contract. You will forego all the interest, not all, but there will be a penalty. You won't get a lot of interest that has accumulated. But still, if you keep it there, if you don't breach the contract, there's no penalty. You will, and the CD interest rate may be something like 1% these days, and which is historically still very low, but it's still better than just savings. But it's still risk-free. All the bank interest rates are basically risk-free. And then the third instrument that is risk-free is always U.S. Treasury securities. U.S. Treasury. And why is U.S. Treasury risk-free? Think about it. If the U.S. federal government borrows, how do they pay back? How do they pay back? In other words, what is the source of the funds to pay back their debt? Hmm?
Our
We all
income.
know. Yeah, their income. Who said that? Who said that?
Tia.
Tia. Okay, Tia, you get 0 0.5. Yeah, we all know the source of the funds to pay back our loan is our income. Just like that, for governments, it's the same thing. Their income, government's income. And what's the source of government income? What's the source of government income? Hmm? Anyone?
Taxes.
The businesses.
Businesses?
Businesses.
No, no,
Yeah.
no. I mean,
The taxes
what
we
business
pay.
are you talking about? Hmm? What business? Someone said.
The
Somebody
taxes we
said.
pay.
Yeah,
Taxes.
taxes. The taxes we pay.
Mhm.
So who said that?
Mukhtar.
Mukhtar. Okay, I believe someone else said that too,
Yeah,
right?
Kelly.
I said that too.
Who?
I don't think you heard me.
Kelly
Kelly.
and Alicia.
Okay, Kelly and Alicia. All right, Kelly and Alicia, you got 0 0.5. Yes, the government's source of income is tax revenue, and then if you think about it, the tax revenue is uh, tax revenue is some kind of percentage, some percentage of the GDP, right? Tax revenue on tax revenue is uh, on average, some average, on average, some percentage of the GDP. So then it goes without saying, only logically, uh, the economy that has the biggest GDP will have the biggest tax revenue, and the biggest tax rev that means deepest pocket, right? The government with the uh, highest tax revenue has the deepest pocket to um, pay the debt, to pay off the debt from, right? So then, nobody, that means nobody is safer than U.S. Federal government, right? If that means, U.S. federal government, in other words, the Treasury Department, has a very um, uh, critical, critical presence in the bond market, because as the borrower in the bond market, U.S. federal government is the biggest player and the safest player. Okay, and suppose if the selling price of the Treasury goes down, what's going to happen? Now, if the selling price goes down, that means, okay, I'll have to write it here. So return on the Treasury is risk-free, and the risk-free return or return on the Treasury is basically calculated this way. And then think about it. This goes down, this goes down. Um, then what happens to the denominator? When
Go
selling price goes down, what happens to the denominator?
go down.
What?
Like
What
the
did you say?
I say it will go down.
It goes down?
Yeah,
No. Why would
the
it go
risk.
down? No, it cannot go down. Why? Selling price selling price goes down, but what about the face value? Does face value go down?
No,
No, face value doesn't go down. Face value is a constant, right? Face value is a constant. So if face value doesn't go down, it's always 1,000, but selling price goes down, what happens to the numerator? Oh, come on, stop. What happens to the numerator? It's a logical
goes
thinking.
up.
It has to go up. The whole the numerator has to go up, right? Numerator has to go up. In other words, this is capital gain, right? Because this goes down, capital gain goes up. So think about it. Numerator goes up, denominator goes down. What happens to the whole fraction? What happens to the whole fraction? Huh? When numerator goes up, denominator goes down, what happens to the whole fraction? It's just logical thinking. Hmm? Only one thing can happen. I mean, what happens to the whole fraction? Anyone?
The fraction will be positive, I think.
What did you say? The
I said
fraction will?
it will be positive.
Oh, yeah, it's positive. It's positive as long as, look, as long as neither numerator or denominator is negative, it will always
Wouldn't
be
it be
positive.
high and popular? Is that what you?
Yeah, say that again.
It will be high and popular.
High. Uh, I don't know if it's going to be popular. I mean, it can be, but what do you mean by high? It will be. You mean go up?
Yeah.
Yeah, it will be higher, right? It will go up. The whole fraction will go up, right? The whole fraction will go up, right? Makes sense. It's just mathematical law. I mean, logic by any logic, think about it. When the numerator goes up, denominator goes down, the whole fraction will have to go up, right? Makes sense. Why is everybody quiet? Huh? Just plug in a few numbers. Try this. Suppose it was, 4/6, right? But then this goes up to 5. What happens to the whole fraction? The whole fraction is higher. Isn't it right? If it is even 6, right? Clearly, this thing is, greater than, this thing is greater than this thing. Right? I mean, this is just a very straightforward logic. I mean, nothing. And who said higher? Who was that? Who said higher?
Tia.
Tia, okay, Tia. So you're getting another 0.5. Um, so think about it. Where was I? So if the price of the Treasury, the selling price, if it goes down, risk-free return will go up. And all other bonds, think about it. I told you, Federal Reserve is the biggest player in the market and the safest player in the market, right? So if the safest and the biggest player is paying higher return, then all other bonds must follow, because otherwise they lose competitiveness. Who's going to buy corporate bonds or other bonds when the safest borrower is paying higher return, right? Safest and the biggest borrower is paying higher return. So all other bonds must pay at least higher or equal to, right? At least coupon rate that is equal to the risk-free return or higher than risk-free return, right? And then, so overall return in the bond market goes up. Now then the banks must also raise their interest rates to stay competitive. Think about it. Both bond markets and banks are also competing for lenders. Isn't that right? And if the bond market is paying higher return, then all the investors will run to the bond market. The banks won't get any deposits. Nobody will put money in the bank. Think about it. On average, in the bond market pays 5% return, and the banks are still paying 0.1% a year. Who's going to put their money in the bank, right? So banks need to also raise the interest rate to stay competitive. So throughout the entire economy, overall interest rate goes up, right? Throughout the entire economy. And it's exactly the mirror image. The opposite is true when price goes down. If the selling price goes down, if the selling price goes up, return goes down, and overall interest rate goes down in the market, and in the bond market, and also overall interest rate in the economy goes down. So then, under what circumstances, why would the price of the Treasury go down? Now, there are only two reasons for any price to go down. Think about it. It is like this. Price will go down when either demand, this is not the right picture. I don't think I have the picture. But the point is, under two conditions. One, supply increases, right? Supply increases, or demand recedes, demand falls, right? So think about it. It's quite obvious. Oh, this noise is really by 3 o'clock they should stop. It's almost, what's the time? I'm not going to draw it anymore. It's a common sense. When supply increases, right, price will have to drop. So one way they can do this is by selling more Treasury securities. If the Federal Reserve sells more Treasury securities, that increases the supply. When the supply increases, the price will fall. And as the price falls, risk-free return goes up, overall interest rate in the economy goes up. And as the interest rate goes up, it becomes more difficult to borrow, right? It becomes more burdensome to borrow. So borrowing goes down. In other words, it is explained here. If interest rate goes up, it discourages borrowing. As the borrowing goes down, money supply throughout the economy goes down. And if the money supply goes down, that cools off the economy. In other words, that Y stands for income as well as output of the economy, right? So the economy goes down, right? And it's exactly the opposite mirror image when Federal Reserve buys back, right? When Federal Reserve buys back the Treasury securities, right? That means more demand. More demand always pushes up the price, right? And as the price rises, then return falls because the capital gain portion, right, the numerator gets smaller and the denominator goes up. So the whole fraction goes down. Whole fraction goes down. So risk-free return goes down. As the risk-free return goes down, overall interest rate in the economy goes down. That encourages borrowing. Lower interest rate. When interest rate is lower, it's easier to borrow, right? Borrowing goes up. As borrowing goes up, money supply goes up. So the economy gets stimulated, right? The income or the output of the economy goes up, right? So this is, basically, how the mechanism of the open market operation. Think about it. When overall interest rate goes up throughout the economy, that also includes the Fed funds rate. Fed funds rate will have to also go up or go down with the open market operation. And also one more thing. Although Federal Reserve sells or buys back Treasury securities, right? It's Federal Reserve who issues the Treasury, right? Treasury securities are issued by the Treasury Department, not by the Federal Reserve. So Federal Reserve sort of, acts like the window for, or broker window for brokerage, right? For the Treasury Department. Okay. Okay, a lot quieter. I think they stopped. I guess it's 2:45. So this is, how the basic mechanism of monetary policy. Now the picture is complete. Why? Because previously we knew that there is an inverse relationship between the interest rate and the economy. The noise again. I said it too soon. There's an inverse relationship, but then what causes the interest rate to go up or go down? That part wasn't explained. Okay, so that part is now explained. Federal Reserve goes into the bond market, and then they either increases the supply of Treasury or decreases the supply of increases the demand for Treasury, and whereby the price of the Treasury goes down or goes up. So which causes the interest rate to go up or go down. Okay, so the picture is now complete. Now again, one thing you need to be careful about is that it's not always the Federal Reserve that causes the interest rate to go up or go down. I mean, Federal Reserve can intervene. It's the Federal Reserve's intervention, policy intervention. In other words, but without the Fed's policy intervention, interest rates can go up or go down endogenously, meaning, by the reasons, within that arises from within the system, right? Endogenously. In other words, think about it. Interest rate will go up if the demand for borrowing goes up, right? Interest rate is the price for borrowing, right? Interest rate is the price for borrowing money. So if there is a strong demand for borrowing, then interest rate will go up. And think about it. When will there be a strong demand for borrowing? If the economy is booming. If the economy is booming, all the businesses will want to expand their capacity, right? Expand their production capacity so that they can, meet the increased demand, right? In other words, if the economy is booming, then next year there will be more demand. Uh, uh, the economy has very a positive, rosy outlook. So year after year, the demand will grow. And as the demand grows by like 5%, 10% a year, then uh, businesses will need to expand their production capacity, right? And to increase their production capacity, then they'll have to borrow, right? And not only the businesses, but households will try to buy their homes, when their income is increasing. So strong demand for borrowing will push up the interest rate. And the opposite is true. When there is no demand when the economy is obviously bad, then no businesses will want to borrow. So the demand for borrowing goes down, interest rate goes down. That's endogenous reason. In other words, that's the reason for interest rate changes coming from within the economic system. But sometimes, Fed wants to quicken this process, right? Fed wants to quicken this process. If you leave it to the business cycle, um, it works very slowly. So Fed wants to quicken the process, so they intervene, and then they do it through the open market operation. Now, once again, uh, Fed's policy tools, right? Monetary, they have more than just one tool. Open market operation is only the most preferred tool, but they also have two other ways in, to change the monetary policy. But I'm not gonna talk about it now. We're out of time. So monetary policy can go either way. In other words, expansionary or contractionary, right? Expansionary means increasing money supply, right, to stimulate the economy. And to achieve this, you will have to lower the interest rate to make the borrowing easier, right? We've Since the financial crisis of 2008, we've had four instances of for implementation of expansionary monetary policy. I put only three there. It was called quantitative easing. Quantitative easing means easing up money supply on a massive quantitative scale. Massively quantitative scale. That's why it's called quantitative easing. But it's basically, expansionary policy. Um, and 2000, so 2008, 2009, and 2012, there were three implementations. And at around 2018, I believe, there was the fourth one, I believe. But quantitative easing is actually more extensive than just easy money policy, because in an ordinary easy money policy, what Federal Reserve does is only buying back only Treasury securities, because that's just conventionally what they do normally. But during the quantitative easing, it was actually large scale asset purchase, right? It was also called large scale asset purchase. So what's the difference? The difference is not only the Federal Reserve did not only bought back only treasuries, but also they bought corporate bonds as well, right? So that way they could, inject massive amount of money into the economy. I mean, Treasury was only buying back Treasury has only limited effect, and under ordinary circumstances, under normal circumstances, that would still have the effect. But after 2008, after the financial crisis, just ordinary expansionary policy would not have impact. So they had to large-scale asset purchase. And every time when they implemented QE, then there was always, this question about whether they going to taper off this time, taper off. What does that mean? Does anyone know what tapering means? Does anyone know what taper in monetary policy context? Anybody thought about that? Okay. Maybe
To
you are not.
reduce.
Oh,
To
yeah,
re-
someone said reduce. Who was that?
Claudia.
Claudia. Okay. Claudia. Yeah, that means reducing the money supply, reducing the extent of the easy money policy. Why? Because taper is something like this. The pencil tip is an example of taper. Now, this is a pencil, right? Pencil tip. Now think about it. This part of the pencil is tapered off, right? Pencil was like, the pencil is like that, and they sharpened it, and then this shape is called taper. So it's a metaphor. Now you can see why they call it taper off. They are tapering off the the easy money policy.
Is it like fading in? Like
fading? Yeah, it's like fading, but
like it gets thicker or thinner as you go?
yeah, thinner, right?
Okay.
But fading is, it's a verb intransitive, meaning, someone fades away, glory fades away. In other words, the subject of the verb fade fades away. But in case of monetary policy, the money supply, you cannot say money supply fades away. I mean, you can probably say that, but the subject of the action, the subject of the verb is the Federal Reserve. So Federal Reserve, you cannot say Federal Reserve fades away.
Yeah, like diminishes.
Right. Federal Reserve diminishes or tapers off, right? The money supply, that massive money supply that was in the. So anyway, so that if that is called quantitative easing, and then because after every quantitative easing, then there was always these skeptics, so because they were always crying out that the Fed is printing out money, so we're gonna be inundated with inflation, but actually it never happened. Those skeptics were generally just against I'm not going to go into the bipartisan politics, so after these quantitative easings, there was always these questions about when do they taper off, but actually Fed didn't have to print money, I mean that was also a metaphor when they through the monetary policy, through quantitative easing, they're not actually injecting, they're not printing money and injecting it into the economy. There's no need for physical printing of money. It's just a metaphor. Now, the opposite of the expansionary monetary policy is, of course, tight monetary policy. This is what they do to cool off the economy when the economy is suffering from high inflation, accelerated inflation, like now. The economy is currently suffering from high inflation, 7.5% a year. So that's why from March, right, in the last Federal Open Market Committee meeting, that's when there are 8 meetings per year, and after each open market committee meeting, they discuss whether to raise interest rate or lower the interest rate or hold a course, and um, after that they hold a press conference, and then they communicate with the public and with the market, where the interest rate will go. So that's called, a Federal Reserve's guidance. So after the last, FOMC meeting, that was January 27th or something, and then they said, they're going to raise interest rate. They are considering raising interest rate in March. So if they to fight the inflation, and they're going to start, already tapering off, right? So it's time to taper off, and then the opposite of quantitative easing is called quantitative tightening. If they do it on a massive scale, it's called quantitative tightening. Okay, so the policy can go either way, right? Alrighty, so I think it's about time to take a break. It's 2:59, so let's take a 10-minute break, and when we come back, we're gonna move on to the next topic of cost of capital. Okay, so let's take a 10-minute. All right, we're back. We're back. I just want to draw your attention to this this posting in the announcement. That was also it went out on Monday. It's about the second self-diagnostic test. It's gonna start tomorrow, so everyone needs to be aware of it, right? I'm sure if you've been paying attention, you would be aware of it already. All right. So then next, so we already understand that the interest rate uh, basically consists of nominal rate consists of real interest rate plus inflation adjustment, right? Um, but this is very basic picture because um, think about it. The real interest rate is the real return on the money, right? And then because of inflation, we are making inflation is a kind of risk, and we are making an adjustment for that risk, right? It's so this inflation adjustment is sort of like risk premium, inflation risk premium. But what other risks are there in bond or in lending in general? In lending, when you're lending money, clearly, clearly, uh, there are more than just inflation risk. Actually, the biggest concern is the default risk, isn't it right? When you're lending money, the biggest question is this borrower going to default or not? Right? Am I going to get my money back or not? That's the biggest risk. So default risk is the second risk. I mean, inflation risk is um, first, and it's across the entire economy. I mean, it's not firm specific, right? It's not company specific or it's not borrower specific, right? It, it's across the board, right? Inflation risk is across the board. If there's an inflation, it affects everyone across the economy. So, and then the second risk is the default risk, and this is borrower specific, right? It's borrower specific. Liquidity risk is also borrower specific, and maturity risk is also economy wide. It's across the entire economy because I'm going to explain that later. Because maturity risk is also called, interest rate risk. Um, so, uh, so let me introduce a new concept, uh, new symbol, K. And what is K? K stands for cost of capital. And the cost of capital means, think about it, is the cost of borrowing money, or rather, to be more generic, cost of raising capital. Cost of raising capital. So there can be two types of capital, only two types of capital, only two types of capital, either debt or equity, right? We're not talking about equity just yet because equity is stock. We're going to be talking about stock later. Uh, but so basically, you understand that the interest rate is the price for borrowing money, price that you pay for borrowing money. In other words, it's cost for raising debt capital, right? Interest rate is the cost of raising debt capital. Um, so basically, a cost of capital consists of base rate plus risk premium. And how many risks are there? At least there are four types of risks, right? And then the base rate consists of pure return, return, right? Pure rate or pure rate of return plus inflation adjustment. So this is, in other words, This is basically I, the nominal rate. Base rate is I, what we have so far called I, nominal interest rate, because nominal interest rate is the real interest rate, which is the pure rate, plus expected inflation. Expected inflation, right? That means expected inflation. And the pure rate, or the real interest rate, pure rate, that's the true earning power of money, right? Earnings power. And it's generally between 2 and 4%. It's generally between 2 and 4%. I would say in these days, we have very low interest rate, historically low interest rate. So about 2% would be the pure return. Remember remember earlier I showed you what the prime rate is like, and what it consists of. Prime rate is the rate that is allowed to the highest quality borrower, right? So in other words, if you have excellent credit score, like credit score above if you have a credit score above 820, you would be considered, that would be excellent excellent credit range. And then less than 5% of the entire population falls into this category. So if you are there, then you will get something like 3.5%, right? That's the prime rate. Prime rate is conventionally Fed funds rate plus 3%, 3 to 3.5%. So think about it. Fed funds rate is only like 0.25, and then so this in this 3%, 2% is the pure return, and the remaining 1.25% would be like inflation adjustment for inflation, right? And because you are prime category borrower, your default risk is almost zero, so there is no need for default risk premium, right? So basically the structure, theoretically, the structure would look like this. The structure of cost of capital is pure return plus inflation premium, right? Inflation risk, inflation adjustment, and this plus this, right? Okay, this plus this is called base rate, right? Base rate, and then there will be a default risk premium, which depends on your credit score or credit rating, liquidity risk premium, and maturity risk premium. So what is liquidity risk premium? What is liquidity, first of all? Liquidity is liquidity means how easily you can convert any asset into cash. Okay. So that's just first level of definition. It can be defined on at least 3 levels. The most basic level is that it's how easily you can turn any asset into cash. And on cash is the most liquid asset, because liquid means it flows from one, easily flows, liquid flows. So cash flow easily flows from one hand to another, right? Cash is the most liquid asset because it's already cash. And then the next level is in the order of liquidity. Next thing is cash equivalent. Cash equivalent is a very short-term asset that has very little variance in the valuation. Value doesn't change, very much. So its cash value is preserved. And then marketable securities such as stocks and bonds, they have cash value and they can be easily converted into cash, but there's a volatility. There's a variance in the its market price. So the cash value may be preserved or not. Okay. And then promissory notes and accounts receivable, but those are liquid assets. So on the first level of definition, it means how easily you can convert any of those assets into cash. Second, on the second level, it means cash flow. Liquidity means cash flow. Now think about it. If a business has a lot of liquid assets, then it won't have any cash flow problem, because if it is tight with cash, then they can always sell those assets and convert them into cash. In other words, they have plenty of assets they can easily liquidate. So on the second level, it means liquidity. It means cash flow. And on the third level, it means money supply. Liquidity means money supply. Why? Because think about it. If every business in the economy has good cash flow, right? If every business and every individual in the economy has, abundant cash flow, what does that mean? There is a lot of money supply throughout the economy, right? So liquidity on the third level means, money supply. But here, in this context, it means basically the first level of definition, right? Now, so liquidity risk means, risk associated with being unable to sell the bond of a little known or unknown issuer. Now think about it. It's a problem. Debt of a small and unknown firm is illiquid. It's not easy to sell, right? It's hard to market. It's not very marketable. Although their credit rating may be good, but the name is not very well known. Generally, they want to avoid such a bond. Okay. So then there must be a risk premium for that. Oops. And then the maturity risk. Clearly, it's related with maturity, and the longer the maturity, the higher the risk. Why? Think about it. Future is always uncertain, right? Future is uncertain, right? And the uncertainty is a risk. Uncertainty is always a risk. And so obviously between 1-year bond and 30-year bond, right? Which one has more risk? Obviously 30-year bond has more risk, because 30 years is such a long time. You can easily, there's no way of knowing what kind of economic event might happen over 30-year time horizon. Whereas, the time, short-term horizon, like 30 days, 60 days, 90 days, 120 days, 180 days, up to 1 year, what economic event might happen is, rather well predicted and well anticipated. And the economic event we are talking about here is interest rate movement. Interest rate movement, because interest rate movement will cause a lot of impact to the bond valuation. Now there may be many ad hoc variables. There were ad hoc factors that were not predicted before. For example, war, right? Something like this. 2 years ago, even a year ago, nobody could predict, if there would be a conflict between Russia and Ukraine. But these things emerged only within the last quarter, right? This event developed more precipitously over the last quarter, but not a year ago, right? But those things are not ad hoc those are ad hoc factors. In other words, some random factors, not the fundamental factors that would affect the bond price. But the interest rate is the factor that would directly affect. It's a fundamental factor that would affect the bond price. So think about it. When, as I said, after every FOMC meeting, the Fed chairman holds a press conference and explains, what stance they have about the economy and how whether they are going to raise interest rate or lower the interest rate. They do this 8 times a year. So we can have, and the market can have pretty good forecast or anticipation about the interest rate movement within like 1 year time frame. And then, but like 5 year into the future, 3 year into the future, 10 years into the future, there's no way of telling what's going to happen, right, over such a long time horizon. So the forecast is really not meaningful. Such a long-term forecast is not really meaningful. At best, 5 years, up to 5 years at best. But more relevant forecast and more accurate forecast is always short-term, like on the 1 year. And the reason that matters is, remember, the interest rate we are talking about is not the coupon interest rate, but you remember what makes the bond a premium bond, what makes it a discount bond, is the relationship between the coupon rate and the prevailing market rate, right? If the coupon rate is greater than the prevailing market rate, it's going to be a premium bond. If the coupon rate is less than the prevailing market rate, it's going to be a discount bond. And think about it. Nobody knew, and we know coupon rate doesn't change because coupon rate is the bound by the contract. I mean, if the bond was issued with 10% coupon rate, with the 10% coupon rate, if the bond was issued with 10% coupon rate, and if it is a 20-year bond, for 20 years, it's going to be 10%, right? It's going to pay you 10%. And at the time, if the market rate was 5%, this becomes a premium bond, right? But as I said, there's no way of forecasting like more than like 5 years, because nobody knows what the interest rate will be like in 5 years. I mean, within 1 year, you can tell pretty much how the interest rate, in other words, how this rate will behave within 1 year. But nobody knows what it's going to be in 5 years. But 5 years later, let's say, 5 years have passed. 5 years later, still the coupon rate will still hold at 10%, but let's say 5 years later, prevailing market rate went up to 15%, right? In 5 years' time. Think about it. You will sustain, it was when you bought the bond, it was clearly a premium bond when you bought it, right? You must have paid more than $1,000, but 5 years later, let's say you have to sell it. But when you sell it, it becomes a discount bond, right? Because the coupon rate is less than the, so what happens if you sell it 5 years later? You will realize capital loss. You will realize capital loss, right? Makes sense? So this is why it is called, also interest rate risk. Interest rate risk. Now you gotta know all of these, the interest rate maturity risk is also called interest rate risk, because the longer the maturity, the interest rate movement, how the interest rate will behave, is unpredictable. That's where the risk is coming from. If the interest rate goes up, right, and it was unpredictable, it goes up 5 years later, and there was no way to predict it from time zero, and when it goes up, then you realize, capital loss, right? So it's also called interest rate risk, and also called price risk. Interest rate risk and price, because it was premium bond previously, now it's discount bond. That's why you you realize capital loss, you incur capital loss. So it's also called price risk. So it goes by different other names, right? So you need to understand that. And also, therefore, this is something that is not very difficult to understand. That brings us to the last topic of the yield curve. Yield curve. What is yield? Yield is basically, remember, I told you, yield is another name for annualized return. Oops. Yield means annualized return, right? And we know annualized returns will have to be, the longer term bonds will have to pay higher return than the shorter term bonds. Okay, because there's a risk associated with longer term bond. And you might wonder, you might say, oh, isn't it obvious? Because if you hold it, if you're buying 30-year bond, the return from 30-year bond must be greater than return from 1-year bond, because it's been 30 years. No, I'm not talking about the holding period return. Of course, if you're with 30-year holding period, right? With the holding period of 30 years, the total return should be greater than just 1-year bond. It goes without saying. But that there's no comparison, right? You cannot compare 30-year holding period return with 1-year holding period return. It's apples, comparing like apples with oranges. That's why we need to annualize everything. So what I'm talking about is the annualized return on the 30-year bond is must be greater than annualized return on 1 year. I mean, it's 1 year anyway. Otherwise, there's no incentive for anybody to invest in 30-year bond. Why? Think about it. If there's no difference between 30-year annualized return of the 30-year bond and 1-year bond, if there's no difference, nobody will tie up their money, nobody will lock up their money into a 30-year instrument, because you can always do the same. You get always the same result by, think about it, putting it into a 1-year bond and rolling it over for 30 years. Make sense? You get the same result. You still get the same result by rolling over 30 years. So the point is, the yield or the annualized return will have to be higher as the maturity increases. So from the shortest maturity, 30 days, 60 days, 90 days, 120 days, 180 days, 1 year, 2 years, 5 years, 10 years, 15 years, 20 years, 30 years. If you plot those yields along the timeline, and the rate on the vertical axis, then connect those dots. The pattern of the shape of the yield curve, shape of the yields would show this upsloping curve. Okay, it will show, that's the normal pattern. But sometimes they show inverted pattern, and that's when they show inverted pattern when the market anticipates, when the market expects recession looming on the short-term horizon. And why? Why is it? Why is a big question. That means, basically, short-term return is greater than the long-term return. Inverted yield curve, short-term return is greater than the long-term return. And why? Think about it this way. When there is a recession, when recession is forecasted, and everyone expects recession within, and this is, you cannot expect forecast recession 5 years from now or 10 years from now, but within like 1 year, it's more accurately forecasted. And so if the recession is expected in 6 months, you're not, what's going to happen to the short-term bonds? Will people put money in the short-term bond if recession is expected? No, people are not going to put their money in the short-term bond. Why? If the bond matures in 9 months, and recession hits in sixth month, right? The company will be caught in the middle of the recession, and they will have hard time coughing up the money. In other words, if the company sold $100 million worth of bonds that matures in 9 months, and the recession hits in the 6th month, the company will be caught in the middle of the recession and will have hard time coughing up $100 million. They may not be able to do that. They can default. And so you don't want your money, you don't want your bond to default. So you pull your money out of short-term bonds, right? And pulling out from short-term bond means you're selling it. If you're selling it, then there is a massive sell-off. So what's going to happen to the price? The price will have to fall.
Go up?
No, price will have to fall.
Oh, go down. Sorry.
Because there's a massive sell-off, right? Price will have to fall. But then what happens to the return? The return will have to go up. And if you don't understand why, this is what I explained in the
like in the house value.
No. In the open market operation. No,
I'm saying like an example.
If with the massive sell-off, the selling price goes down, right? But the face value remains. So return has to go up. In other words, there is an inverse. This is a very important thing. There is an inverse relationship. There is always an inverse relationship between the return and the price. There is always an inverse relationship. And there's something, I probably wrote it here somewhere. Can't find it, but you'll see it later. There is an inverse relationship between return and the price. If the price goes down, return goes up. If the price goes up, return goes down. So, as with a massive sell-off, the price of the short-term bonds go down, so the return goes up. And when they pull out of the short-term bond, they will put that money into the long-term bonds. Why? Long-term bonds can weather out the recession. Why? If you put the money in the 10-year bond, because the maturity is 10 years, they don't have to cough up the money in 6 months or 9 months. So recession will be long gone, right? By the time they will have to cough up, $100 million. 10 years later, nobody knows. I mean, what's going to happen, but the short-term recession that's going to happen in the short term they will survive that. They will weather it out. It will be, so they will survive, because during the recession, they only need to pay the interest. So they can weather out the storm, and 10 years later, then they can, they can come up with the money. Or if you're not sure about that, after the recession, you can sell your holdings, right? But the point is, so there will be a massive sell-off in the short-term bond, and that money will be put into the long-term bonds. There will be a massive buy. Massive buy would, push up the price. If the price goes up, return goes down, right? That's why it will display an inverted yield curve. So inverted yield curve is a sign of a signal for impending recession. Okay, but sometimes it may not materialize, because in my main lecture, I explained it using, when the time is already, yes, we're about 4 minutes past. You see, there is a Fed funds rate versus 1 month T-bill versus 10-year Treasury note. This is about inverted yield curve. 2019, there was inverted yield curve in the middle of the year, right? About May, June, July through like October, there was inverted yield curve. But actually, the recession didn't materialize. But the inverted yield curve was, quite evident at the time. Generally, it is taken as the signal for impending recession. Okay, and the rationale behind it, the logic behind it, is important. All right, that's all the time we have. Any questions so far? Any questions?
Professor?
Yeah,
Yes, there is.
Sapphire.
The
Yes.
pi sign, right, in interest rate and inflation. Can you explain to me why it's not called pi, it's called inflation?
No. Pi is the symbol for inflation. Pi is just the symbol for inflation. I've been using pi as the symbol for inflation, and in macroeconomic context, pi is the symbol for inflation. In microeconomics context, pi is the symbol for profit. Okay, so yeah. Any other questions?
Okay, thank you.
Okay, if you have further questions, first stay online. Okay, I will have to call it a day. Just we have time to call it quits. So have a great afternoon, and please don't forget that the second test is starting tomorrow. Any more questions? So the class is dismissed. I will stop sharing and stop recording. But if you have any further questions, I will stay for a couple of more minutes. All right. Have a great afternoon. All right. I'll stop.
Thank you.
Thank you,
Great
Professor. Have a
afternoon.
good day.
All right. You're welcome.
You too, Professor.
You too. All right. Take care now. I'll stop recording.